Hey everybody, welcome to this free edition of our Trader User Group, a weekly roundup. This is for the trading week ending September 25, 2020. I'm Preston Brent. Thanks for tuning in. As always, please remember you do not want to be the rat brain trader. You want to be the red striped zebra. You want to stand out in the crowd. This week's theme essentially is are we in a bull trap or where are we going to go to next? Let's kind of take a step back and take a look at where most of the major markets are right now. And then we'll jump into a little bit about the weekly sound bites and we'll take a look at the charts and see how they're stacking up. So first things first, let's take a look at the markets and see what's going on. If we look at the markets right now, you can see that the US index performance for this week, mostly in the red, but the rare green is Nasdaq. It finished the week up 1.11%. You can see year to date, both the S&P and Nasdaq are still in the green. S&P barely holding on. We did go into the red briefly this past week, but we managed to finish out. Although we did finish just below zero this week in the S&P. Russell really had a bad week, down 4%. Year to date, down 11%. You can see the trailing 12-month PE ratio for the S&P is at 35.55, really a large number. Even the Ford PE ratio is still relatively high at 24.92. The Ford PE is lower by about almost 30% from the trailing, but that we would expect. The dividend yield right now on the S&P is at 1.82%. The 10-year Treasury is at 65.9 basis points. The spread between the two is 1.16, so that's still going to channel a lot of money, asset allocation back into the equity market. And you can see the VIX, it did finish the week up about 2.1%, but the VIX is still relatively elevated, but not, as severe as you would expect, with the markets performing the way they have. Now, this past week, the best performing sector was technology, finishing the week in the green 2.56%. As you can see, the worst energy, just a whopping 8.35 to the downside. And then the annual sector performance, you can see technologies leading the way, 31.29%, with technology bringing up the rear at 44.64%. Now look at the world index performance. You can see the only spot of green is the year-to-date performance of China, and that was over 11%. Now it's down 5.55%. But you can see both the FTSE, that's the London index, and the CAC 40, the French, they're both in bear market territory. The FTSE at 22.54, CAC 40 at 20.88. DAX, which is the strongest economy over in Europe, making up the European Union, is still underwater, almost 5.9%. Hang Seng down almost in bear market territory. Nikkei is down 1.91% year to date. Everybody had a red week this week across Europe and the Asian markets. So we did see the Asian market slow down dramatically this week, along with the European markets. And if we take a look at this week's market here in the U.S., let's just kind of focus on some weekly sound bites here, just a little bit of a clip note version, and then we'll jump into the charts. The markets continue, as I say, to see some volatility, but not as high as you would expect. The benchmark indexes this week, we had our fourth consecutive week of declines. Okay, that's 4 in a row. That's the longest stretch we've had in almost a year. And we saw the S&P this week briefly enter into an official correction territory, that'd be underwater by 10% or more. And we did see an attempted rally, but just really not strong enough to move us up this week. And the economic data that we're seeing printed here in the U.S., it is slowing down. It's gradually improving, but it's kind of in I would say a consolidation point right now. This past Thursday, we saw that the weekly initial jobless claims rose just a little bit to about 870,000. So that's 4,000 or 5,000 unemployment claims that it went up. So for all practical purposes, it's just flat week to week. Continuing claims continue to decline, but not as much as people were thinking. And we did see the manufacturing sector appear to remain in fairly good shape as companies are restocking their inventories And the services sector declined, for the first time since April, but barely. So we're in this kind of consolidation pause phase right now. And then, of course, if we look at the interest rates and money, you can see the yield on the benchmark 10-year Treasury moved just a little bit lower this week. Economic and really political uncertainty with the elections coming up here in the U.S., virus concerns, these kind of things that basically added to this risk-off sentiment that we've seen for this fourth week in a row of down moves. Okay, and the real bond yields, which is the nominal rate, the real yield, or the yield of the stated yield, I guess would be a better way to say it, of the bond less inflation, is still currently negative. And guys, you got to understand that when we have real yields that are below zero, that's going to continue to force more asset allocation into higher yielding assets. And for fixed income people, that would be like corporates, municipals, and also more into equities as well. And we're seeing this has a tendency to inflate higher corporate valuations because it's driving the PE ratios higher when you've got lower interest rates. And then you add in the monetary support by the feds, especially they're given to the corporate markets too. It just tends to, a lifting tide lifts all boats, including those boats that shouldn't be lifted in the corporate market. So paybacks are going to be a bitch for this, but near term, with all the money sloshing around, there's no place else for money to go. Okay, so that's kind of what we're seeing. And as I showed you on the previous slide, all the markets across Europe pretty much finished into the red this week. And you can see that this rebound in Europe, the Eurozone business activity, it kind of faltered. We're seeing the PMI data basically lose steam in the month of September. We're seeing rising COVID infection rates. There's a fear of more shutdowns, although all the governments over in Europe have said they're not going to shut things down like they did in March, but they're going to slower the opening, I guess. So this is all having a sentiment effect all across the Eurozone. Okay. The September PMI data for Europe, for the Eurozone, came in at 50.1. That was down from 50.9 in August. So remember, anything below 50 is a contractionary type of environment. So net, we're still very cautious, these markets. And that's why I had said, are we in a bull trap? Let's take a look at the markets and just kind of see how they're shaping up just a little bit here. So I'm going to switch the screen over. So just bear with me as the screen repaints on your screen. It may take a second or two before it comes up. But what you're going to see here is my customized index that I have of essentially the high-flying tech stocks. That would be Microsoft, Facebook, Apple, Netflix, Google, and Amazon. And you can see here, this is a weekly chart. You can see going all the way back really to about the summer of 2018, we've stayed in this steady upsloping channel. Okay. Remember, it takes 2 touch points in the channel to define a trend line. And we've had them here. And then we broke out of this channel officially back in June of this year, the end of June going into July. And then we had this huge run up, and then we broke this upsloping trend line here. And we did the official break back on September the 7th, just after Labor Day holidays here in the United States. And again, this is a weekly chart. So you can see that, to me, any kind of move up, obviously the first thing we're going to want to check on is, are we going to move up, do a retest of this trend line, or perhaps right up around this level here and then roll back over, test this low, and then come back into the channel again. Until we get a break back, then we must assume that the momentum is going to carry to the downside. If I put it on a daily chart, let's zoom in just a little bit. You can see here just how close we are to the upper boundary of the upsloping trend line. You can see we're still below the 50 EMA. We're above the 200 EMA, which to me would be more of a support element than anything else on this. Now, this is a special index, but you can see the sell-off that we had. Everybody just got a little bit too elevated here. And if I bounce it out, you can see here where this was the pre-pandemic high back here in February 19th. and then we tested it probably for a few weeks, and then we finally got clearance above the pre-pandemic high back in June 15th, and then we just had this really fast move higher. Okay, and now we've given up a lot of that move, and it would not surprise me again to see a little bit of a move higher and then a roll back over again. So we're still very much in a, are we in a bull trap moment, or will it go higher? You can see in the Elliott wave count, my system automatically counts and readjusts Elliott waves. It would suggest that we're in this four leg down that can be very complicated. It can be kind of a flat four that can run out for another 2 or 3 months before turning higher. But traditionally, that does mean that we're going to run higher and take out this three leg here at 21,371, but not without a lot of fireworks and sparks going off in the interim. Okay. Now, if we come down here and we look at the S&P, and you'll see here on the S&P how we're above this blue dash line. So we're back in the green year to date. As I said, year to date, we're in up 2.09% roughly for the SPX. Now, this is the E-mini future, so it's slightly different pricing than the SPX, but you can see this move. Now note, this is an Elliott wave 3 down. That would mean this is an impulse move down, which would suggest we're going to move higher and then roll back over and then make a lower low down here. You can see we regained the 23.6 fib node from the key prior pivot high and a pivot low. We're still below the 50 EMA. So obviously this 50 EMA, sitting right around 33.17 is going to be a resistance point for us. You can see there's no divergences down here in the MACD. So I am still of the opinion that any move higher is probably going to be sold off in the short term. The only thing that would get me out of that line of logic is if we get back over the 3,400 level. Once we move over that 3,400 level, and then that becomes a support element, and I can see bulls stepping in at that level, then I would be more than ready to change my polarity and bias to the upside. Right now, it's neutral to slightly down, and it's still so. If we come over and look at Nasdaq, which has gotten hurt, you can see with Nasdaq, we just regained the 50 EMA at Friday's close. Nasdaq was up good on Friday. It was up 243 points. Notice here on Nasdaq, this is not an Elliott wave 3 down. This is an Elliott wave 4 down. That would suggest that we can have an extended 4 pattern, and then we're going to take out these highs again. So we're getting some mixed signals. There is no divergences here positive that would suggest a lot of money's waiting to come in. So I'm of the opinion also that neutral to slightly down, it's going to be choppy. We're going to see volatility hang in there through the election. Keep in mind that the last time we had a delayed election, which I think is going to be this one as well, we're not going to know the winner right away because of all the mail-in ballots. They've already said that the ballots are going to be counted up until like a couple of weeks later. So if any of these contests are not blowouts in some of these key states, then they're going to wait for a couple of weeks. The last time that happened, and then it was challenged in court, was Bush and Gore here in the United States about 12 years ago, and it took almost 30 days to resolve that with the Supreme Court. And during that time frame, the markets fell almost 6% in the S&P. So we're going to see volatility elevated through the election. So just understand that the risk of the bigger, faster move is to the downside. Now, having said all of this, the one thing, actually there's two things that can drive the markets higher very quick, but we may get a fast sell-off post news, but it could happen. Number one, we get a fiscal stimulus here in the United States that's agreed to by both the Democratic and the Republican Party. Right now, they're almost $1 trillion off. I think the Dems are coming in at 2.3, 2.5. The Republicans are around 1 trillion. It's a little bit more than $1 trillion off. If they come up with a stimulus package, you'll see the markets move up dramatically. And then you can expect a little bit of a drift back down again after that announcement over a week or so. But the bigger push is with the vaccine. Here in the United States, we have 3 companies in stage 3, as you guys know or should know. Stage 3 is the final before the FDA comes in when they release the results, and the FDA says you're good to go, send it out to the public, or no, you need to change this or change that. We got 3 of these due to come out sometime in early to late October. So if one of those hits, you're going to see the markets explode higher. Members, we've got our list ready of companies that we want to jump on should that happen. It will be a huge move higher. In many sectors, all sectors actually, but there's some where the return on capital is going to be much greater. So these are just some of the things that can really change the markets literally on a dime. You go out in the morning for lunch and you come back, or for breakfast, you come back and the market's completely flipped. So we can expect something like that. If we come over here and we look at the volatility, and we take a look at vol, and you can see here we're in the rose-colored zone, so we're still elevated, right? We're not even in the yellow. We're still elevated up, but still lower than I think we should be. But or high, I think we're lower. I think we should be really north of 30. But some of the speculation is the Nasdaq, the allocations as we came through, or as we're going through this week, the end of Q3, the third quarter. Remember how mutual funds and big pension funds allocate. They don't just say, okay, we're going to buy 1,000,000 shares of this or 1,000,000 shares of that. What they'll do is they'll allocate. They may say we're going to allocate 34% of our portfolio that's available for investing. We're going to allocate it to tech, and then they break that down accordingly. But what happens is when tech has been on a run since March 23rd lows, that 34% allocation every quarter, it keeps getting bigger and bigger of their total allocation. So what they're forced to do at the end of the quarter, as we go through quarter end, is sell off some of that to reallocate their allocation, if you will. So we're going to see that again this week. So some of this selling is not necessarily money coming out of the market. It's just being reallocated to cyclicals and industrials, maybe some chemicals and things like that. So we can expect more of that. And I think that's been a big part of what we've seen thus far, because technology and Nasdaq and the FANGs just got too ahead of themselves. So we can expect more of that as we go through this next week, because the allocation models just got a little bit clogged and too one-sided. And what's happened is with this sell-off in the month of August, we saw more put buying than we really did in September with some of this pullback. So even though the markets have been pulling back and the volatility has been pulling back, what's been happening is we've seen some of these big funds monetize some of their puts by taking them off the table, holding less puts, and that's driven vol a little bit lower, even while markets have come back a little bit lower. So the markets are not that afraid right now. And that's created this situation where we've had the VIX falling as the markets have fallen. Just really an unusual situation. We don't see that very often, at least I don't see it very often. But that's what we've got. So there's just not that much fear out there. If we look at the front month vol skew as just evidence of that, this is the VIX compared to the October vol futures. You can see we're in the green. So it's in a normal backwardation, in a normal contango environment. This is a normal skew. If we look at the back month skew, this one too is in the green. Notice we've been in the red for quite some time in the backwardation. This was due to the vol futures in October expiring before the election, but the November vol futures expire after the election. So we front loaded some of the volatility into October. And then you're going to see it's also front loaded into November and then in December, and then it starts to die down again. So the market makers are building in an anticipation of a little bit of agina post-election for the next 6 weeks or so. So just expect that. For you options traders out there, for folks in our group, we're playing this. We've got strategies that work really well in this kind of environment. And if you don't understand how volatility works and how it affects your premium or the cost of holding a put or a call or a strategy, then you're missing out. Of course, if we look at treasuries, we look at the bond market here, uh, basically flat. I mean, that's kind of where we've been. Strategies, this has worked well for some of the strategies I've been touting to our members in the bond market. Again, I've talked about different ways of playing that, primarily with TLT. It hadn't gone anywhere. TLT goes in the direction of bonds, opposite interest rates. So it's really, remember, I like TLT better than TBT. TBT here goes in the direction of interest rates. All right. So when interest rates go lower, TBT goes lower. When interest rates go higher, TBT goes higher. But there's no premium in this. It's a $15 ultra share, 2x. So you just, when you're holding these things, you just don't get compensated for the extra risk that you should. So TLT is a better instrument to play, in my humble opinion, than TBT. Of course, if you can play options and bonds, that's an even better market, I believe, than TLT. If we look at currencies, look at the dollar. The dollar is in this up mode right here. We've cleared the 50 EMA. You can see we're in this 3-4 possible 5-leg pattern, and I'm projecting downside, but I want to see how far this rolls. Soon as, if this dollar, and that's really the dollar index, a lot of people don't understand this. The dollar doesn't move independent of other currencies. Other currencies are actually what moves the dollar index, not the other way around. So, for example, the euro is 57.6% of the dollar index. The yen is about 13.6. The pound is about 11.9%. Okay. Then you got the Canadian dollar, the Swedish krona, you got the Swiss franc. When you add them all up, it equals 100% of the dollar index. So think of the dollar index like an ETF of currencies, and it's just quoted as dollars. So when the euro goes up, generally the dollar index goes down and vice versa. So now this does suggest, as I mentioned earlier, all across Europe they're having problems. If we look at the euro, you'll see the euro is moving lower. The euro is broken down below the 50 EMA. It broke that level and we're coming back down. It does suggest it's going to find some support here in this 4-leg down before we move higher, but I'm not seeing any divergence yet. So that suggests we do have some more downside to go in the euro, which would be upside in the dollar near term. The only reason why the euro is going lower right now is the European economy is having a little bit more fits and starts with their economy than the US, all right? And actually this is going to help the European economy because with a cheaper euro, their exports are cheaper. So that should, basically help them out a pretty good little bit. If we come over here and look at gold, well, guess what? Gold is breaking down, guys. With a stronger dollar, inflation nowhere to be found. You're going to see this is what gold is going to do, right? I mean, especially with a stronger dollar. We broke that upslope and trend line. We've come down. We've taken out the 50. I expect to find support around the 1800 level. We're right at that, right below that 50% fib node. I want to see if we can get back up. As you guys remember, I actually had and called for gold to get up over 2180, 2200, but I said I'm not taking that trade if we don't get back up over 1950, and we never did. We never really cleared the 23.6 fib retracement here from that prior pivot high. So as long as we didn't do that, I was standing down. I did not want to take shorts, but that was kind of the trade. Silver was the same thing. Silver has also broken down, right? So on the next move higher, silver is coming down to a strong support point. On the next move up, my preference would be to be long silver because your return on capital is much better in silver than it is in gold. In fact, I've got a longer term target of silver of over 33, almost 34, but not near term. Okay, so let's just wait and see how this thing plays itself out. Meanwhile, with oil, as you guys know, it's just sucked for the week. But you can see we're in this trend, this tight area. This is my support area around 35, and it works really well in the oil futures market to go out a couple of months playing iron condors and flies, especially the way we do our flies. These are just perfect for that. Let's look at Nat Gas. Nat Gas really gave it all up, had a kind of a reflex move like this. This is a I think this is a bull trap. I think it's going to come back down again. That's just a one-day move. I think it's going to move up and roll back down again. So I would not be suckered into that. I was hopeful back over here that it would pull back and then make a higher high. And then we would then be able to short it at a better price. We just did not get that trade, so we didn't take it. I mean, we can pick the trades we want to play, right? So this just didn't line up the way we wanted. There were other better trades to take. So this is kind of where oil is sitting right now. Now we have some action in ags, meats, and softs. We got some other things going on in other equities that to me seem interesting. Members, I will talk to you guys this Sunday evening. We'll go through some things. Otherwise, if you're not a member of our group, I highly encourage you to come in. We're having a great year this year, especially in the options market with what volatility is doing and the way we trade it. I think you guys will have a lot of fun with it. Members, I'll see you Sunday night. Everybody else, see you next weekend for our next weekly roundup. Have a great weekend, everybody. Take care now.